Well, hello everybody. Welcome to Middle Class Investor. This is Seth Martin. It is Friday, October 5th, about 4:30, and markets have been closed now for about an hour and a half. And we had another, kind of a follow-through day on the sell-off that we had Thursday. So the market looks like, it wants to go down right here. Let's zoom in on. This is a daily chart that I've got up here. So you can see we kind of ran up to this high, and then we didn't quite make a new high. And initially to me this looks very ABC-ish, and of course we'll have to wait till next week to see a little bit more evidence come out. But as of right now, that's what it looks like to me. It looks like a buy the dip kind of situation. If it's not, I mean, there's more bearish potential. I mean, there's bearish potential with where we are in the market, namely down here on the MACD. Let me zoom in and I'll show you here on the weekly chart. You can see the MACD. First of all, there's a bearish divergence going on here. If you look at this peak, kind of coincides with the this wave 3 high back in February, and then this whole run up is at a lower high, even though the market's at a higher high. Let me show you that. You can kind of see here where these line up. It's kind of hard to get it all on one page, but let me see if I can do it. So you can see here this lines up with this, but then this peak, the market made a higher high, but the internals didn't make a higher high. So the MACD kind of represents momentum, some of the internals. And you'll see this with the advanced decline line and some other indicators that people use. And so this is pretty typical of what's called an intermarket divergence. So we see that on the index as well. That was the SPY that I had up. The index shows the same divergence. So that's potentially bearish. The market just barely made a new high over the February high. So, normally you would expect, if this is a wave 5, for it to be a little bit longer, but it could just be the time. There's nothing saying that it has to be longer. Could just be as long as it's going to get, and that's it. Let's look at the VIX, because the VIX is finally doing something. We talked about it last week and how it had sold off and had been going back down. But we should see an increase in the VIX this week, which we have, although not significant. But it is curling up, and looks like it wants to go higher. So we'll just have to wait and see what happens next week. If there's going to be a follow-through on this market action, or if it's going to be a bounce that takes us off to new highs in the coming weeks. Here's Germany. Germany sold off this week and last week. We've talked about how Germany looks like it's in this downward channel here, and if it breaks out of the channel to the downside, then we could probably say that the trend has changed in Germany. Although right now this just looks like a big pullback, and maybe a good place for it to stop would be this gap back here. The market might fill the gap and then bounce. But like I said, if it breaks, the price action starts to accelerate through this channel, then I think we can say that Germany has topped and is going lower. Let's look at Japan. Interest rates have started going up, by the way. They've hit, 2-year highs or 3-year highs or something like that. And there's a lot of talk about how that's hurting emerging markets. You can see a huge divergence here well, this isn't really divergence because this is not at a higher high, but you can see that Japan looks really weak here, and wouldn't be surprised if this downtrend is beginning. Although technically to really make sure, I would wait to see Japan break below this channel. Same thing with the United Kingdom and the U.S. I mean, just any of these big index markets. If we get a break below this line here in the UK, then you could say that the UK was probably topping or has topped. All right, what I want to look at is the 10-year yield. That's what I think is starting to happen is the 10-year yield starting to accelerate quicker than people anticipate, and I think this is starting to cause some problems in the market, especially the emerging markets. But it'll have problems in the U.S. too. Right now, we're still at a level where the people say, oh, well, it's because the economy's growing and the dollar is strengthening and all this kind of stuff. The dollar is strengthening. That is a fact. But the economy is not really doing better than most people think. The economy is doing better than it actually is. And a lot of that has to do with, the new highs. It has to do with this technology talk and boom that we're experiencing. It's just some people are looking at the chart and comparing it to other charts in the past and showing similarities that, where this is just beginning, and so on and so forth. I really think if you're following that line of thinking, you're going to be in big time trouble. I just watched Jim Grant the other day. Jim Grant writes the Grant interest letter or something like that. Jim Grant's interest letter. And he was talking about how the 35-year bull market in bonds is likely over, and we're probably headed for a 35-year decline in bonds, i.e. a rise in yields. So he's not the only one talking about that. Jim Rogers talking about that. There's a lot of people talking about that, but they're mostly smarter people like Ray Dalio. Not sure if you know any of these names, but there are some people that are recognizing this potential topping action in the bond market, or the bond market being the run being over, and people are starting to talk about how the Fed is making a mistake. I mean, there's just a lot of things lining up, and of course, we've been talking about that for a while. Clearly, we were way early. And being early is not always helpful, but it's better than losing, tons of money. Even if you've foregone, the last 10-15% of the upside, at least and you're better off, I think, than you would be if you hung in there and ended up losing 60, 70, 80% to the downside. So there's always a time to make money in the markets, but sometimes, especially with this degree of trend that we're experiencing, and what I mean by that is, the beginning of this trend goes way, 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 way back. Like, let me pull up the Dow. That's probably the best way to look at it. The beginning of this trend goes back further than I actually have data for. So the sell-off could be significant, and I've got this little yellow box down here. I would think this would be maybe the worst case scenario. Well, the worst case scenario I think actually could be this low right in here, which coincides with the 1987 low. I don't think we'll go any lower than that. and I think likely will settle somewhere around 2025, something like that, 2500. But we're going to have a significant, very significant bear market, and I don't know. Just most people don't believe it. They don't. Oh, that's impossible. How could it possibly go that low? Well, what you got to it has to do with credit, and we basically spent the last 35 years ballooning up credit in the Federal Reserve and the banking system. And there's too much debt to service. I mean, the people that own the debt, once their assets get reevaluated or revalued, what they're going to find is they don't have enough cash flow to actually manage the debt that they've taken on. And so essentially what happens is you have reshuffling of assets and debt collapse or default, which gets assets out of weak hands and puts them in strong hands, puts them in the hands of entrepreneurs that understand these types of problems. And so a lot of people are going to have to lose in this next deal because a lot of people made huge mistakes. So that's how it can happen. It's happened in the past, and it can happen again. So don't believe for a minute. Here's a different picture. This is the 1929 crash. So just to kind of review that for a second, this was a pretty big sell-off right here that lasted a couple of months, 3 months, and people were so relieved when the market was rallying, and then it just proceeded to just take everything from them. So you went from, what is this, 387 all the way down to 200, and people were like, oh my gosh, they'd lost everything. At that time they felt like they'd lost everything. And then again, the way the psychology works on you, it started to rally back up to here, rolled over, and just proceeded to take every last dollar from people. So 387 all the way down here to what is that? 41. That is a huge sell-off. So the market can do anything, and you need to make sure that you understand that and you're prepared for that. All right. We looked at Treasury yield. I don't think there's anything. Let's move on over to the charts, and let's look at some items there. Let's look at gold first, gold and silver. Let me get a different chart up here. All right, here's gold. This was the run up from 1999, hit 1911. This is likely, all this right here. Let me just draw it. All this right here, from here all the way to here, is likely an A move for a larger degree, ABC. So what would that look like? Well, A ended here. B is likely to end, somewhere around in here. And then C is likely to end, somewhere below, somewhere below A, bottom of A, somewhere down here. So we got a long way to go in gold and silver. Now, the gold and silver are doing different things. Silver is historically, what is it, 50 to 1 or something like that. There's a ratio, or 7 to 1 or something like that. There's a ratio between gold and silver, and right now that ratio is such that silver's the better buy than gold. And that's why probably the two charts are diverging a little bit. But I think what both charts show is that we're headed for a pretty good, maybe a year-long secular bull market in gold and silver. Let's look at silver. That's the gold. The difference between the two markets is silver looks like it's kind of a sideways type of, you've got A, and it looks like maybe B will resolve itself, excuse me, in an A, B, C. So you could have silver, for example, and this happens sometimes when you're dealing with things like Elliott wave. This is A right to here, right? Well, then you have an A, a B, and I don't know if it's going to work out like this or not, but it could, okay? An A, B, and C, and then this would be like B. So then C down would be, something back below this 13 in the future here. So, but what does that mean? That means we're looking at silver running up to $26, $27. So that's a pretty good move. That's a doubling thereabouts of silver. So if you want to buy silver, I think this is a good area to buy silver. Maybe up into the $26 area, and then once you get into the $26, you'll be looking to sell silver. But again, this could be a year and a half long move, and I think it's when the market's going down, you want to look for things that are going up. So I think silver and gold are going to be two of those things that are going to be going up. I think oil, on the other hand, is going to be going down. But we might experience oil something like this, where it's consolidating. So it might go here, and then here, an A, B, C, and then an A, B, C, and an A, B, C, and so on and so forth, and then break for the final move down below to new lows. Probably could be as low as won't be below $10, but somewhere between $26 and $10, and then you'll never see oil that low again, in my opinion, based on the chart. So let's see. Let's look at the euro. If it'll come up, there we go. There's the euro. So the euro is likely, it's likely had pretty big ABC move down, and we're looking for the euro, or maybe this is A, B, and C, and we need C to finish out here. And this looks a lot like a 1, 2, 3, 4, 5. So we're having some sort of pullback. Now, my guess is right now that the euro is going to bounce probably up here into this 1.12 area, and then roll over and come down below. The reason I don't think it's done yet is because this is only to, let's see, this is from, what's the date there? That is February 2018 to August 13 of 2018. That's only like 5 months. Whereas this run up was from, let's see if I can get some dates here. January 2017 to February 2018. So the run up was 14 months, and so far we've only had a 5-month pullback. So I would say that the pullback, the ABC, it could very well be twice this long. So what I'm looking to happen is for the euro to run up into this area here in resistance, and then sell off to something down below here, lower, or it could run up even a little higher than this, where this would be an A, and we'd have a B and a C and a D and an E, and then a new high for this run up here. I don't know. It's hard to say. It could be. I don't know. I mean, what I definitely feel like is a good move here is euro is probably going to trade up into this 1.19 area where this box is. But then probably need to be out of the euro. Just watch the euro and the dollar. Those are very interesting markets. There's a lot going on in the European Union right now. There's a lot of interesting things. Of course, on the media, the key when you listen to the media is they'll get the causality completely wrong. They'll say, this happened in Germany and it caused the markets to do this or that. And really, once you go back and, if you're looking at the S&P 500, what they'll do is they'll go back and they'll, once we're down in this area, they'll say, yeah, this started to happen, that started to happen. But what you'll notice is they'll be several months off. So the causality is always wrong. The market internally moves because people act a certain way together while they're trading in this market, and that's what creates these waves and these this kind of social mood phenomenon. So we'll continue to follow it. Like I said, this week we've had a pretty big sell-off. That's pretty much a dark cloud cover, which is usually a bearish candlestick, but we need to confirm it. We need to get a close next week below this. So if we do, then we can call this a dark cloud cover or a bearish harami, or there's a bunch of different names for it. But bottom line is it means lower prices are ahead. So I hope that helps everybody. Feel free to copy the URL and send it to your friends and family. I think we're getting really close to a point where the middle class investor is really going to start helping people that are having a hard time deciding what to do with their money, with their 401k. The whole goal of having a 401k or any kind of retirement is to make sure you are on the sidelines when assets start to fall, so that you're not experiencing those losses. All right, everybody, thanks for coming in, and we'll talk to you next week. Bye-bye.